I'm going to finish up because I'm going to put investing and financing activities together. They're going to be very short. And I will show you just a smidgen of what you would call non-cash investing and financing schedule. So now we're looking at investing activities and how we're going to analyze that. We're looking at plant assets, investments, notes receivable, all long-term. You'll notice usually notes receivable are long-term. And it always helps to do this with a T account. In this case, we're just kind of going to make some assumptions. First thing we look at is when we sold that asset. You remember that difference? You have to figure out what the cash really was in that sale. So you're going to use all of that information from the sale. First of all, it was, we had accumulated depreciation of $15,000. It was on the books at $55,000 cost. And they paid $50,000 cash. They've done a strange thing here. Usually when you look at a journal entry, all the information is going to be here. So if they had that $10,000 gain, we would have to balance out this activity, this journal entry. So this is $65,000 compared to the $15,000 in accumulated depreciation, which would mean you use $50,000 in cash. As I said, if you're looking at the books and if you have everything that you need in front of you, you're probably going to have this journal entry to complete this. Next thing they looked at is they made a payment for the acquisition of some plant assets, and they spent $310,000 for that. So that's a use. So when you compare these two, you have a net cash used by investing activities of $260,000. That takes care of that section. Now we'll move on to financing, and you'll look at long-term notes payable, bonds payable, common stocks, and retained earnings, the changes in those. So let's see what we had. And in this case, the retained earnings is what is really going to be scrutinized to see if there were any dividends. Because ending retained earnings equals beginning retained earnings plus net income minus loss minus dividends. And we can account for $80,000 in the beginning. We can account for the net income. We didn't have a loss, so that's 0. But I can't, this 120, okay, versus 110 does not balance. So the remainder is dividends. So I need this. How do I balance this equation here? I would have to say the dividends are $10,000 in this case, which they are. So that ends up being put together. We have a receipt of, because we issued a note payable for $90,000, we paid $10,000 on a note. We sold some common stock, and we bought some treasury stock. And then we deduct those payments for the dividends. And that gives us net cash provided by financing of $170,000. Now let's put this all together, add them up, and oh wow, we've got a decrease in cash of $20,000. We had a beginning balance of $42,000. If I take that $20,000, I end up with, I should have a cash balance of $22,000 on the balance sheet at the end of December. Now let's go up and see if we do, if I can find that balance sheet. And looky there. We have a balance of $22,000. That's what you're doing. You're reconciling the net income with the actual change in cash. And it's such a beautiful statement to put together to come up with this. And I went too far, didn't I? Let's see. So this was way too far. Here is the non-cash. Okay, these are examples of what would be non-cash investing and financing. You've got acquisition of a building by issuing common stock, no money. But we did increase, right? We have acquisition of land by issuing a note payable. Again, no money. And then we retired notes payable by issuing common stock. So these are non-cash investing in finance activities that you would put at the bottom as a schedule. And one final note, I will show you the use of free cash flow to evaluate business performance. And what does that mean? So you're going to sit down and you look at this and you say, okay, what's our true free cash flow? They expect a net cash provided by operations of $200,000. It plans to spend $160,000 to modernize retail and pay $15,000 in cash dividends. So here is the equation: net cash provided by operating activities minus cash payments for investments in long-term assets minus dividends gives us free cash flow. And in this case, it's $25,000. So you can put these numbers in combination to see how much money is really going to be available for paying bills. So it's a beautiful, beautiful statement. So I hope you enjoy doing it as much as I do. And that covers my overview on this. See you in the next one, which is financial analysis.